Welcome to After Hours Action. I'm Greg Greenberg from The Street. And yes, we are on Twitter Watch as we await the social media site's IPO tomorrow. One name getting a little action in after hours trading is Qualcomm, which disappointed The Street with its revenue guidance and is trading down 5% at last check. Whole Foods is down 8% in the after hours after same-store sales rose too slowly for Wall Street's taste. Now, before we start talking Twitter, let's wrap up the market. The S&P finished up 8 points to a record high 1770, while the Dow closed 129 points higher to a record of its own. The Nas was down today by 8 points, and that's somewhat surprising considering we are on the eve of the year's biggest tech IPO. The catalyst for today's bull run was a surge in European shares over speculation that the ECB will ease again. As for individual stocks, Tesla shares sank 15% after last night's earnings report didn't quite live up to Wall Street's Model S expectations. Ralph Lauren fared much better, popping 5.5% after it raised its dividend and 2014 sales outlook. And finally, Time Warner fell almost 1% despite beating street profit estimates as advertising and subscriber fees grew more than expected. Now, Twitter's IPO is certainly the top story in the extended hours. At last check, the stock is likely to price somewhere between $25 and $28 a share. At $28 a share, the company would raise $2.3 billion and put a market value of $16 billion on the microblogging service. Goldman Sachs and Morgan Stanley are the underwriters of the deal, so they surely want tomorrow's offering to go smoothly, as does the NYSE, which will list Twitter under the ticker TWTR. The big fear, of course, is setting too high a price and repeating last year's Facebook debacle. Twitter originally estimated a share price range of 17 to 20, so clearly the demand is out there. The company lost $143 million over the past 4 quarters on revenue of $534 million. Now, let's talk a little bit more about stocks. If you invested in a low-cost S&P index fund, you would be up 24% this year and enjoying those record highs. If you were in a mutual fund which hedged its bets, like a lot of new funds these days, then you would not be having as much fun. You may be sleeping better at night, but you would be sitting out on a lot of the party. Here to talk about whether an alternative mutual fund is right for you is Jim Dilworth of the S1 Fund. Welcome, Jim.
Thanks, Greg.
All right, there's a lot of these new hedged mutual funds out there, mutual funds which act like hedge funds. Why are you seeing such a big growth in it, especially when the indexes, those plain old simple indexes, are doing so well?
Well, we'd be sleeping a lot better at night had we be up 24% as well, of course. Really the secret with alternative mutual funds, we're in the long-short equity space, and really we're products like ours that have a low beta. We don't intend to be up with the market, particularly in a market environment like this, because we short individual securities. So obviously we have had some pain this year like other long-short managers.
And your fund's up 4% this year, but once again, it's not meant to track the indexes. It's not meant to shoot out the lights. So what are some of the strategies that are working for you if, for example, shorting individual stocks is not working?
Well, we're focused primarily on long-short equity, as I said. We have a number of sector specialists that work within our fund for us. And we're seeing a some opportunities in the tech space, healthcare, telecommunications as well. But with valuations where they are, we're seeing some more opportunities on both the long and the short side, and we're praying and hoping for a pullback in here at some point.
And how do you choose the managers and the sectors for your fund?
Well, we start by looking at various sectors that we want to touch in our fund complex, and we interview hundreds of funds every year. And then we try to fill in the areas where we feel like we need to get some exposure within the fund. And as I said, we're focused on sector specialists. Right now we've got a hole in the healthcare space. We'd like to touch that. And if the right manager comes along, we'd be interested in talking to them.
And how much of a person's portfolio should they put in a fund like the S1 Fund?
Well, that's a great question, because products like ours, as I said, you can buy cheap betas as you referenced. You can buy the SPY for nothing. And so products like ours really are providing a ballast for a client portfolio, and we're not advisors in the sense that we tell clients how much to put in our fund, but registered investment advisors, institutions tend to put anywhere from 20 to 30% of their client assets in alternative products like an alternative mutual fund.
And then do you think everyone's watching not only Twitter, but they're watching the SAC guys pony up a whole lot of money to the government? Do you think that's knocking hedge funds? Clearly it's a knock against hedge funds. It's putting them in a bad spotlight, following on what happened with Bernie Madoff. So do you think the fact that you're using hedge fund strategies in a mutual fund strategy, so there's more daylight there, that's better for everybody? It's a more pleasing choice to the masses.
We feel like the mutual fund structure really is the highest integrity structure to provide these products in.
What I was trying to say.
Right, and in a sense, because we provide a daily NAV, we know, we provide our holdings every quarter, et cetera. We think this is a much better way to invest if you're going to invest in a hedge fund strategy. And within long-short equity, these are pretty plain vanilla strategies. We're not using derivatives, we're not using leverage, et cetera.
And I guess when you finally get that pullback, then you'll see why people want to be hedged. Because right now, it's a hard case to make, right?
It's a pretty challenging case to make, and I think the majority of folks in our industry are hoping and praying for some kind of a nice pullback where we can see the whites of our eyes again and provide some value to our clients.
Thanks, Jim. And thank you for watching After Hours Action on the Street. I'm Greg Greenberg. I'll see you tomorrow.